Something happened in the last 48 hours that almost nobody is talking about. While you were watching the markets react to new trade tensions on this one-year anniversary of Liberation Day, something far more dangerous was moving silently underneath every bank, every brokerage account, and every dollar you have ever saved. $1.6 trillion in bank reserves has quietly begun evaporating from the United States financial system. Not through a crash, not through a headline, through a mechanism so technical, so deliberately obscure, that the people running it are counting on you never learning its name. But here's what they cannot hide. The Federal Reserve's own officials gave a speech this morning, Thursday, the 2nd of April, 2026, warning that the banking system is approaching the edge of what they call ample reserves. Below that edge, what happened in September 2019 happens again. Overnight lending. Rates do not just tick up, they explode. And when they explode, the damage does not stay in the plumbing. It bleeds into every asset class you own. This is not speculation. This is the pattern. It has happened before. It is happening again. And right now, you have a window that is closing fast. Stay with me. Because by the end of this, you are going to understand something that the anchors, the analysts, and the bank executives desperately do not want in your hands. Let us start with the number, $1.6 trillion. To put that in context, the entire economy of Canada is roughly $2.2 trillion. We are talking about an amount of money larger than most nations on Earth simply disappearing from the most critical layer of the United States financial system in a matter of weeks. And this week, from Monday the 30th of March through today, the drain has entered its most dangerous phase yet. This is not a theory. This is published Federal Reserve data. Speeches from the Dallas Fed, the New York Fed, and the Board of Governors all confirm the same terrifying reality. Bank reserves, the cash that keeps every bank in America functional, are being drained into a government account at a pace the system has not seen in years. And the timing could not be worse. Here's what most people do not understand. There is a four-stage pattern that plays out every single time the financial system approaches a liquidity crisis. It does not matter if it is 1929, 2008, or 2019. The mechanism is always the same. Stage 1 is the illusion of abundance. Stage 2 is the silent drain. Stage 3 is the 48-hour gap. And Stage 4 is the moment the system loses control. We are entering Stage 3 right now, not approaching it, entering it. And I'm going to show you exactly how the data confirms every stage. Let us build the framework so you understand what is actually happening. In Stage 1, abundance is real. The system is flush. Banks are sitting on enormous cushions of reserves. Lending is easy. Overnight rates are calm. Nobody is worried. This was the world from 2020 through 2022, when the Federal Reserve's balance sheet swelled to nearly $9 trillion and bank reserves peaked at approximately $4.3 trillion. That is, more than 1.3 times the total current reserves in the system today. The word they used during that period was abundant, not ample. Abundant. There is a crucial difference, and I will come back to it. Stage 2 is when the drain begins. It is deliberate, it is policy, and it is quiet. The Federal Reserve begins quantitative tightening in June 2022. Month after month, they allow bonds to mature off their balance sheet without replacing them. Reserves begin to fall from 4.3 trillion to 4 trillion to 3.5 trillion to 3 trillion. By December 1st, 2025, when the Fed finally stopped the runoff, reserves had fallen by approximately $1.3 trillion. But here is what they did not fully account for. The overnight reverse repurchase facility, the other giant liquidity buffer in the system, simultaneously drained from $2.5 trillion to near zero. When you add those two numbers together, the effective liquidity cushion the banking system lost during Stage 2 is staggering. That is the $1.6 trillion and more that is evaporated. And now comes the thing that will keep you up at night. Stage 3 is the 48-hour gap. This is the moment when a predictable, scheduled event drains reserves faster than any backstop can refill them. It is a known, documented annual phenomenon. Tax season. Every April, hundreds of billions of dollars flow out of private bank accounts and into the Treasury General Account, the government's checking account at the Federal Reserve. When money moves into the TGA, it does not stay in the financial system. It locks up. It goes dark. It becomes unavailable to banks for any overnight lending, any payment settlement, any of the critical plumbing that keeps the system running. And this year, that drain is happening on top of an already depleted reserve base. Here are the numbers, verified, from the Federal Reserve Bank of New York's own speech delivered on the 26th of March, 2026. Just 7 days. Ago. The Treasury General Account stood at $840 billion on March 25th. The Treasury's own projection, filed in the quarterly refunding statement on February 4th of this year, estimated the TGA would peak at approximately $1 trillion and 25 billion by late April. That is an additional $185 billion that will be sucked out of bank reserves in the next few weeks, on top of an already thin cushion, during the most volatile geopolitical and trade moment in a decade. Check, verified, undeniable, and stage 4 is what happens when the system cannot absorb the drain fast enough. Overnight rates spike, banks scramble for cash, lending ceases. The Fed is forced into emergency intervention. We have seen stage 4 before. Let me show you the proof that this is not theory. This is a repeating historical fact. September the 16th, 2019. Write that date down. The repo market, the $12 trillion daily overnight funding market that underpins every major financial institution in America, suddenly stopped working. Overnight, a completely predictable combination of events hit simultaneously. $70 billion was withdrawn from banks and money market funds to meet quarterly tax payments. $50 billion in long-term treasuries settled simultaneously, forcing dealers to use reserve buffers. The drain happened in a 48-hour window. There was no margin for error, and the result was catastrophic. The secured overnight financing rate, the benchmark that governs trillions in contracts, spiked 300 basis points above the federal funds rate. Some individual repo transactions touched 9%. The system was running on the functional equivalent of fumes. The Fed had to inject $180 billion in emergency repo operations, the largest intervention of that kind in over 2 decades, to prevent the plumbing from completely seizing. What had caused it? Exactly what is happening right now. Quantitative tightening had drained $700 billion from the system. Reserves had fallen to a level that looked adequate on paper, but proved dangerously thin when the 48-hour gap arrived. The Federal Reserve had miscalculated where the floor was. They thought abundant meant safe. It did not. And the consequence of that miscalculation rippled through every overnight rate in the country for weeks. Can this happen again? The Federal Reserve built the standing repo facility after September 2019 to prevent exactly that. But here is the thing about that facility. On December 31st, 2025, the last day of the year, banks borrowed $74.6 billion from the New York Fed's standing repo facility in a single day. A single day. And in October 2025, usage of that facility hit a record $29.4 billion in one session, described by analysts as the largest intervention of that kind in over 2 decades. The backstop is being used repeatedly. That is not a system in control. That is a system already leaning on its emergency brake. Now let us go to the second historical proof, January the 1st, 2025. Bank reserves fell by $326 billion in a single week. $326 billion gone in 7 days. Bloomberg reported it at the time as the largest weekly slide in 2.5 years. Reserves plunged from above $3 trillion to $2.89 trillion in 1 week. Why? Tax season flows accelerating into the TGA, compounded by end-of-year balance sheet dynamics. The 48-hour gap showed up not as a single day, but as a cascading week-long drain. The system held, but just barely. And that week, overnight lending rates climbed to 4% and above, signaling that reserves were no longer abundant. They were barely ample. Which brings us to the word ample. The Federal Reserve uses this word very carefully. It is not the same as abundant. Abundant means there is excess liquidity everywhere. Ample means there is just enough to prevent a crisis. The shift from abundant to ample is the shift from comfort to the knife's edge. And here is what the Dallas Fed's president said in a speech this very morning, Thursday, the 2nd of April, 2026. Quote, "The minimum size of the Fed's balance sheet is determined by demand for its liabilities, such as currency and bank reserves. If we do not meet the demand, financial pressures result." That sentence is a quiet alarm bell ringing in plain English. Meet the demand or face financial pressures. And right now, the demand is rising faster than the supply can keep pace. The third historical proof comes from March 2020, the dash for cash. As markets collapsed under that shock of the pandemic lockdowns, the repo market again seized. Repo rates spiked to over 10%. Treasury securities, the safest asset in the world, could not be sold fast enough to generate cash. Bid-ask spreads blew out. Order books collapsed. The Federal Reserve was forced to inject trillions of dollars in emergency liquidity within days. What was the mechanism? The 48-hour gap again. Not an epidemic, not a crash in asset prices per se. A sudden violent mismatch between the demand for overnight cash and the supply of reserves available to meet it. The plumbing failed. And when the plumbing fails, everything downstream drowns. Check, verified, undeniable. Now apply the pattern to today, Thursday the 2nd of April 2026. Stage 1, the illusion of abundance, ran from 2020 through 2022. Bank reserves peaked at $4.3 trillion. The overnight reverse repurchase facility was absorbing $2.5 trillion from money market funds alone. The system was awash in liquidity. The Fed's balance sheet hit nearly $9 trillion. Everyone felt safe. Nothing could go wrong. Stage 2, the silent drain, ran from June 2022 through December 2025. Quantitative tightening removed over $1.3 trillion in reserves. The overnight reverse repo facility drained from $2.5 trillion to near zero, removing that entire buffer from the system. By October 2025, bank reserves had hit $2.8 trillion, a 5-year low. Overnight rates in the private repo market climbed persistently above the Fed's interest on reserve balances rate, a textbook early warning signal. The spread between SOFR and IORB was widening steadily, described by market analysts as a creeping stress building beneath an otherwise orderly surface. The standing repo facility went from virtually unused to being tapped daily. In December 2025, the Fed blinked. They halted quantitative tightening entirely effective December 1st. And they announced something unprecedented. They would begin buying $40 billion per month in Treasury bills to inject reserves back into the system. But here is the critical detail they buried in the technical language. The New York Fed's own statement, published March 31st, 2026, just 2 days ago, admits the reason for those emergency purchases was not current stress. It was what they knew was coming. The desk anticipated a large and rapid drain of reserves in April amid tax season-related payment flows into the TGA. Absent any action, there was a high likelihood that those flows would have pushed reserves below the ample range, potentially creating challenges for effective rate control. Read that again, slowly. High likelihood, below the ample range, challenges for effective rate control. That is, the Federal Reserve, in its own published language, saying that without emergency intervention, the 48-hour gap of April 2026 would have broken the system. Check. Verified. Undeniable. But here is what they are not saying loudly enough. The $40 billion per month they have been buying since December is designed to be a buffer. It has been running for roughly 4 months. Total injections. Approximately $160 billion in new Treasury bill purchases. But the TGA is expected to grow by $185 billion in the next few weeks alone. The math is tight, dangerously tight, and that is assuming no external shocks hit the system simultaneously. Now look at what is happening externally. Today, April the 2nd, 2026, is the 1-year anniversary of Liberation Day. The original tariff shock of April the 2nd, 2025 sent the S&P 500 down more than 12% in 7 trading days. It was described as the largest global market decline since the 2020 COVID crash. It triggered a dash for safety so severe that Treasury yields moved counterintuitively upward, meaning investors were actually selling Treasuries, the supposed safe haven, to raise cash. The leverage unwind in the so-called swap spread trade forced institutions to rapidly dump long-term government bonds. Longer-term Treasury yields climbed 30 basis points above their April 2nd, 2025 level in just 9 days. Treasury market liquidity deteriorated sharply. Bid-ask spreads blew out to levels matching the March 2023 regional banking crisis. The system nearly buckled. And 1 year later, on this exact anniversary, new Section 301 trade investigations have been launched against more than a dozen trading partners, including China, the European Union, Japan, Switzerland, and India. The Supreme Court struck down the original Liberation Day tariffs in February 2026, but new mechanisms for imposing duties are already being built. The uncertainty is not fading, it is compounding, and markets under sustained policy uncertainty behave exactly like a patient with uncontrolled blood pressure. They look fine until they do not. Meanwhile, the tariff aftermath from last year has yet to be fully absorbed. Economists have documented a 12 to 18-month lag between tariff imposition and peak consumer price impact. That places the maximum consumer price pressure from the 2025 tariffs between April and October 2026, starting now. Food prices are already up 2.8% from last year's tariff actions. Fresh produce is up 4%. Sugar and sweets have climbed 5.7% year-on-year through January 2026. And the Yale Budget Lab projects a further 6.7% increase in food costs ahead. The average household is absorbing an estimated additional $1,400 per year in tariff-driven costs. All of this happening while the financial plumbing that keeps credit flowing, interest rates stable, and bank deposits safe is entering its most vulnerable period in years. This brings us to the most dangerous variable in the 48-hour gap. It is not the tax drain itself. It is the interaction between the drain and the new normal the Fed has created. When reserves were abundant, the system had enormous shock absorbers. A $200 billion drain in a week barely moved rates. But when reserves are ample, meaning just barely sufficient, the demand curve for cash becomes steep and inelastic. What that means in plain English is this: when reserves are thin, a small additional drain causes a disproportionately large spike in overnight rates. It is not linear, it is exponential. The closer you get to the edge, the more violent the reaction to any further pressure. The Dallas Fed president confirmed this dynamic in her speech this morning. She said explicitly that sudden changes in liquidity supply have larger effects on money market rates when the balance sheet is smaller. A small shock that would have caused no ripple in 2021 can cause a 500 basis point spike today. And the shock that is coming is not small, it is scheduled, documented, and already in motion. Here's a number that ties everything together: $2.5 to $2.7 trillion. That is the critical threshold below which analysts, the Fed's own research, and banking exchange data all confirm that significant stress will emerge. Not might emerge, will emerge. Current reserves stand at approximately $3 trillion. The buffer above the danger zone is only $300 to $500 billion. The tax season TGA drain alone is expected to remove another $185 billion in the next 3 weeks. That leaves a cushion that could be as thin as $100 to $300 billion above the critical threshold at the peak of tax season drain. One unexpected event, one large settlement fail, one foreign central bank accelerating its treasury sales, one bank pulling back from overnight lending at the wrong moment, and the 48-hour gap becomes the 48 hours that broke the market. Now let us talk about what this means for the people watching right now, because understanding the pattern without knowing what to do with it is just anxiety with better vocabulary. First, the people who will be hurt most are not the billionaires. They have access to information, hedges, and alternative asset classes that ordinary investors do not. The people who will be hurt most are the ones who assume that their money market funds, their treasury exposure, and their bank deposits are safe because they always have been. They are safe until the plumbing fails. And then the sequence moves fast. Second, do not confuse the Fed's intervention for a solution. Every time the Fed has stepped in since September 2019, from the repo crisis to March 2020 to the December 2025 T-bill purchases, they have temporarily patched the leak without fixing the pipe. The underlying structural reality is that the American financial system now requires continuous, active liquidity management at a scale that was unimaginable 20 years ago. The Fed's balance sheet cannot go back to $800 billion. It cannot go back to $2 trillion. The structural demand for reserves keeps growing because banks, payment systems, and financial markets have all scaled to expect an ocean of liquidity. When that ocean recedes, even slightly, the exposed reef is catastrophic. Third, the people who will be best positioned are the ones who understand the difference between where prices go during the 48-hour gap and where prices go after the Fed intervenes to end it. During the gap, the snap is violent and fast. Cash becomes king, equities fall, credit spreads blow out. Safe assets that are actually liquid outperform. After the intervention, the opposite happens. Assets that were punished during the panic recover. And the Fed's emergency liquidity injection often sparks a brief but powerful surge in risk assets as cheap money floods back in. We saw this in 2019, in 2020, and in December 2025, when the $40 billion in monthly T-bill purchases were announced and markets rallied immediately. Fourth, monitor 3 specific indicators in the coming days and weeks. The first is SOFR minus I or B, the spread between the secured overnight financing rate and the interest rate the Fed pays on reserve balances. If the spread widens sharply, it is the first signal that reserves are insufficient for demand. The second is the daily usage of the standing repo facility. If daily borrowings from that facility consistently exceed $50 billion, the system is leaning up hard on its emergency backstop, and the backstop itself is becoming a structural necessity rather than a safety valve. The third is TGA balance. If the Treasury General Account climbs toward or past $1 trillion in April, every dollar above $840 billion is a dollar sucked out of bank reserves. Watch the TGA like a hawk. It is the most honest real-time indicator of reserve pressure that is publicly available. Fifth, understand that the debunking of 3 dangerous myths is now urgent. The first myth is that this time is different because the Fed learned its lesson. No. The Fed stopped quantitative tightening on December 1st, 2025, because the system was already showing signs of seizing. They did not learn the lesson. They stopped the damage one step before catastrophe. The lesson would have been not to drain $1.3 trillion in reserves in the first place. The second myth is that America's reserve currency status protects us. It does not. It means the damage from a 48-hour gap here ripples globally, which creates feedback loops that amplify the original shock. What starts as a domestic repo rate spike becomes a global dollar squeeze that accelerates foreign selling of treasuries, which pushes yields higher, which tightens financial conditions further, which makes the original drain worse. The reserve currency status is a two-edged sword. The third myth is that the Fed can always print its way out. It can inject liquidity, but injecting liquidity after a spike in overnight rates has already happened is like trying to stop a car crash by calling an ambulance. The ambulance can save the patient. It cannot prevent the collision. And here is the final piece that should cause you to reconsider every assumption you have made about financial safety in the year ahead. The Federal Reserve's own published research, released in January 2026, introduced a concept called the central bank balance sheet trilemma. The trilemma states that a central bank with a smaller balance sheet must choose between three goals that cannot all be achieved simultaneously: low volatility and short-term interest rates, limited market intervention, and a small, efficient balance sheet. You can only pick two. The Fed chose a large balance sheet after 2020, which gave them low volatility and limited intervention. When they tried to shrink it through quantitative tightening, they did not achieve a small balance sheet. They just created more volatility and forced more frequent intervention. The trilemma is inescapable. The system is structurally dependent on a large Fed balance sheet forever, and every attempt to shrink it below the critical threshold creates the conditions for the 48-hour gap. This is not political. This is not partisan. This is mathematics and plumbing. The pipes are visible, the pressure is measurable, the historical pattern is documented in detail by the very institutions managing the system. The only variable is whether you are positioned to understand what is coming before the gap arrives. The pattern has 4 stages. Stage 1 is abundance. Stage 2 is silent drain. Stage 3 is the 48-hour gap. Stage 4 is emergency intervention, followed by a temporary normalization, and then a structural dependence on even more liquidity. We are in stage 3 right now. Stage 4 is coming, and when it arrives, it will be called a technical adjustment by officials, an overreaction by anchors, and a buying opportunity by the people who understood stage 3 while everyone else was distracted. Right now, today, the most important thing you can do is understand the mechanism you just learned. Share this with someone who deserves to know it. Subscribe, because every week I track the numbers that the mainstream misses, and I tell you what they mean in plain language before the gap arrives. And watch the next video, because the exact playbook for what happens after the Fed intervenes in a stage 4 liquidity event is one of the most misunderstood and most inactionable patterns in modern financial history. The people who know it have consistently outperformed everyone who did not. The 48-hour gap is not a warning anymore. It is a clock, and it started ticking on Monday.